Hi, I'm Chip Stites, and this is The Laughing Retirement. You'll notice I'm dressed a little bit differently. As a matter of fact, I don't put on a tie very often anymore. And when I was working, I'd rather have a bow tie on than a tie. This particular bow tie is called the Churchill because it's the one that Winston Churchill wore most often. And one might think that today's subject is academic. It's not. It's personal. And it has always interested me as I go to share screen that we are the richest country in the world. By most standards, the richest country in history. And yet, more of us worry about having enough money to retire and about keeping that money, and it's about what is happening to that money than ever before. Strange that a place with so much money worries about being able to keep it. There's a book out. It's been out since, I think, 1949. It's called The Intelligent Investor. Mine's dog-eared and underlined and tabbed. And the person who wrote the commentary in this book, it was originally written by Benjamin Graham. The person who wrote the commentary is a guy named Jason Zweig, who has been the senior writer for Money Magazine, et cetera, et cetera. I believe now he's with the Wall Street Journal, and he wrote the commentary for this book. He also wrote a series of articles in his blog about what makes a successful investor. Why is it that most of us are not successful? For the most part, this is an academic subject. This is something that scholars talk about. But the truth is, this is personal. It's very personal. And it's one of the reasons why you worry. So I'm going to get rid of the academics. I'm going to get rid of the supposedly scholastic side of this. And we're going to take a look at the 10 characteristics of the successful investor. Now, we teach this in our course, but we approach it from process. Today, we're going to approach it from the point of view of personal characteristics. And if you want to write this down, and if you want to grade yourself on each of these sections, please be my guest. It'll help. And it may help you realize why you're concerned about not having enough money. So what's number one? Number one is responsibility. I put this number one. It is not one from Mr. Zweig. It is not one that he put in there, but I believe is critical. Do we take responsibility for our money, for our investments, for our returns? Do we know what our returns are? If you look at history and you look at, you read the book and you look at what people think about themselves versus the truth, let me read you something. A poll was taken in late 2000. Time and CNN asked more than 1,000 likely voters where they thought they were if they thought they were in the top 1% by income. 19% placed themselves among the richest 1% of Americans. That's not possible. In late 1997, a survey of 750 investors found that 74% believed their mutual fund holdings would consistently beat Standard & Poor's each year, even though most funds failed to beat the S&P 500 in the long run, and many, many funds failed to beat the S&P 500 ever. We don't know what is happening to us with our money. We give it to other people and we hope they'll take care of us. But we don't seem to realize that nobody goes to Wall Street to make someone else rich. We tend to believe what we are told our returns are. And yet, if you read John Bogle, you read a number of other, Jeremy Siegel, you read Mark Lichtenfeld, you will quickly see that the returns that the mutual funds say they earn are not the same thing that you earn at your bottom line. I look at mine every day. I can tell you what's happening on a day-to-day basis. I take responsibility for it. Am I an excellent saver? No. So when it comes to responsibility, I would have to give myself a 7 or an 8. Do I know exactly what's happening with what I have? Yes, I do, down to the penny, every day. But am I as good at savings as I should be? No. So on responsibility, I'm going to give myself a 7 or an 8. Now, from here on out, many of these, all but 2 of these, are from Jason Zweig, senior financial writer for the Wall Street Journal, commentator in the 2003 Intelligent Investor book, and HarperCollins was the publisher. He would say that the first one is independence, and I agree. After taking responsibility, you have to be independent. Because if you're going along with the herd, like most people do, you're probably not going to be successful. That's why we worry about how much money we have in retirement. Because if you were really successful, you wouldn't be worried about what you have, would you? So do you have a disdain for what the herd is doing? Right now, it's the Magnificent Seven. Are you willing to run with an idea that you have about investing? Are you willing to research that idea? Are you willing to go it alone? Everybody says, oh, I'm doing this, I'm doing great, I'm doing that. Are you willing to stand aside and say nothing? Are you willing to know that what you're doing in the long run works out better? In independence, I give myself a 9. I tend to be extremely independent. I have a fire to create this body of knowledge that I've created so that other people can use it easily, simply, and understand what they are doing and get a direction from it. As a matter of fact, at the end, I'll talk about a masterclass that we're doing in a couple of weeks that I'd like you to take a look at. It's free. Independence is the first quality of what makes an investor successful. And it enables you to find and to have all of the others. The third one is skepticism. The first day after I got my broker's license, my mentor told me, never believe, excuse me, never believe what anybody tells you. Never believe when it comes to investing what you're reading. Don't take for granted the idea that, well, this is how it's done. A sense that you trust yourself above all others, regardless of the outcome. Here again, I give myself a 9 or a 10. I'm pretty skeptical. I don't believe what everybody else is doing or what everybody else is saying. Because if what everybody else was doing and saying was, we'd all be rich, wouldn't we? We'd all be following the touts. And the racetrack, when you go to the racetrack and you pay $5 for that tout book, you'd walk away a millionaire. You'd have hit it every time. It's the same thing with the talking heads on Wall Street. Don't believe it. They're popular today. They're popular for a while. The idea works. I made $1 billion in Bitcoin. How many Bitcoin millionaires are there today? Do you know any? A desire to know what the correct answer is. If you're a skeptic, you want to know what your correct answer is. You want to know if your thoughts and feelings have validity. Again, in this area, I score pretty high. Courage. The understanding that you're going to be wrong, that your call, that your investment is going to be wrong from time to time. But you go ahead with the process that you have created. And that's another thing. Most people don't create a process. We're going to talk about that. The willingness to go on the road less traveled. You know, Benjamin Graham talks about it. Jeremy Siegel talks about it in Stocks for the Long Run. Mark Lichtenfeld talks about it in Get Rich with Dividends. David Bosson talks about it in The Case for Dividend Growth. The experts write about this over and over and over again, but we don't read and we don't listen. We tend to be like lemmings in a herd that run and follow the group right over the edge of the cliff. How many times have I heard, well, I got scared and I got out in 2009 after I'd lost 50%. I didn't get back in until 2017. I'm scared. The enemy of the equity investor is expenses and emotion. Warren Buffett. The desire you have to see something through to its end. The desire to push that button for the first time and buy yourself your first stock that's going to pay you out for the rest of your life. A willingness to make a true assessment of yourself. That's courage. In this area, I give myself a 5 or a 6 because I make mistakes. I do. I don't always think things through. Now, do I have the guts to do something? Yes, I do. But all of these things frame together. I'll give myself a 6 or a 7 on courage. Now, patience. On patience, I'll give myself a 9 or a 10 because I am patient. I'm willing to see something through. I'm willing to watch it go up and down and see what happens. And more often, my patience has proven me right. Did you know that the longer you hold a stock, the less risk you wind up taking in that stock if you're reinvesting the dividends? We teach something in the course called yield to cost. We tend to think of the yield of what it's paying you, but suppose you bought something 3 years ago and it's worth more and you're earning more. What's your yield to the original cost? I have a stock where my original yield was 5.75%. My yield to cost today is 10.6. You see, that's patience over years. The average holding time in a stock back in the 60s and 70s was 5 years. The average holding time now is 5 months. You see, we turn over our investments. When history would tell us, statistics would tell us, the more your mutual fund turns over, the less you're likely to make. One reason is trading costs. Number two, every time you turn over, you think that something else is going to do better. And the pros don't know. They don't know what's going to happen in the future. Otherwise, you'd be rich, wouldn't you? If they knew what was going to happen every time in the future, you'd be rich. But they don't. Patience is the desire to see how something's going to turn out. Again, excuse me, I rate myself kind of high in this. I have patience. Process. You know, one of the reasons people fail is that they don't have a process. They're more or less throwing spaghetti up on the wall and hoping a piece sticks here and there. We have a process. I have a process. After 45 years of experience and understanding and making this mistake and that mistake, I've put together a simple process. 4 to 6 clicks of a mouse, and you can learn how to pick an excellent stock that will stay with you for years. And once you have learned our course, you can go out and create your own process so that you have a process that you are comfortable with. I don't want to tell you mine's the only way to invest. That'd be stupid. David Bowson has a way. Mark Lichtenfeld has a way. Benjamin Graham had a way. Warren Buffett has a way. Jason Zweig has a way. They're all more or less done around the same thing. And that's what fascinated me. Do you know what foundations create? In essence, in many ways, Berkshire Hathaway is kind of a foundation, isn't it? He gets in some ridiculous number of millions a year in dividends that he can use for other things. He doesn't pay them out, he uses them to make deals. Understanding the consistency created by using the same methods again and again under different circumstances creates a process. And that process over the long term creates success. We've created a process here at the Laughing Retirement. Understanding that using one method and tweaking it as necessarily from time to time. It's like why your style of driving a car is not anyone else's style, but you all went through roughly the same school. Your style of fly fishing will not be like anybody else's, even if you go to the same school, because it's you. Your style of investing is not going to be the same, even if you go through the same school, because you are going to put your own ideas and parts to it. So having a process is one of the biggest reasons why people fail. Independence, skepticism, patience, courage, curiosity. Number 7, a consistent desire to know more, a consistent desire to understand, a consistent desire to want to know well enough to satisfy yourself. I don't know if curiosity is first or last, but in the area of process, I'll give myself a 10. In the area of curiosity, I'll give myself a 9. I am learning to become an investor. I have a long way to go, guys. I'm still learning, still tweaking things, still trying to understand after 45 years. This fascinates me. Discipline. This is one of those places I have to give myself a 4 or 5 because I'm not always disciplined. My biggest mistakes were for lack of discipline. The things that I did wrong the most while I was working was lack of discipline, of listening to the herd, of thinking, this is going to happen, of not being patient. Discipline is the control of yourself to see something through, to not be emotional, to understand what the detail of the discipline is so that you can use the process to define how you are going to invest. That's discipline. And it's probably the lowest of the areas that I have. Measuring system, how do you consistently gauge what you're getting? And what do you use as a measuring stick to gauge it against? I use the S&P 500. I'm taking roughly 69% of the risk of S&P 500, 31% less risk than the S&P 500. And if you'll come to our masterclass or look at the masterclass, which is free, incidentally, I'll show you how I've done. And you can see how some of the class members have done compared to the S&P 500, because we teach a measuring system. You have to measure to know where you are. You have to. Humility. To know from time to time, regardless of your process, regardless of your discipline, regardless of your courage, regardless of your patience, you're going to get stomped on. Humility, I don't know. I'll give myself a 5 or a 6. I think you have to promote yourself somewhat in this life to get other people to listen to you. I don't talk a lot about what I do when I'm outside with friends. We don't talk about business. But here, this is business. You have to know that others are going to say, well, I made 20%, I made 30%, I did this, I did that. Most of the time, they have no clue. And almost all the time, the best thing for you to do is keep your mouth shut. When I listened to other people talk when I was working, and I didn't talk about business at parties. I could listen to other people brag about how they were doing. I've even heard my own clients brag about stuff they didn't want me to buy that's done well. You have to know that the herd will pronounce your thoughts dead, your ideas worthless. How many times have I seen splashed across the Wall Street Journal or across Money Magazine or something, value is dead? Done right, value is never dead. And I'll tell you something else. The financial services industry works to make money for themselves first, for the people who sell their products second, and for you last. And in a year in which you lose money, they will still make money. Now, I'm going to go through this real quick one more time, because I want you to grade yourself and I want you to look at this quickly. And I want you to understand the value of what you're seeing here. Number one is responsibility. You have to take responsibility for your own money. If you are giving your money to somebody else, I guarantee you, you may have a great financial advisor. You may. But he's taking money, and as long as he follows the guidelines that you set out when you were first there, it doesn't matter what the markets do, doesn't matter how much you own. Take responsibility for your money. Read Jason Zweig. Independence, skepticism, the willingness to say, I'm not sure that's right, the independence to stand aside from the herd, the courage to do what you believe is right, the patience to see something through, having a process, step by step by step. We have 28 lessons to teach people to create this process. The curiosity to want to know what works and what doesn't. The discipline to stay with an idea even when you aren't sure, and then tweaking it afterwards after you have measured it. And finally, the humility to smile and say nothing. That's what makes a really good investor. I hope you've learned a lot about the characteristics of a successful investor. Because after all, one of the purposes of this website is to help you live a better life, is to help you take control of your money, is to help you understand what makes a successful way to invest. Now, to that end, we're having a masterclass on March 24th at 11 a.m. Eastern Daylight Time. There's a link below that you can click and join this free class. Bring a notebook, bring a pencil. And at the end, after you've been through the class, you're going to be able to ask me questions online live. And I'll stay there until we run out of questions or I run out of energy. Either one of the two. What are we going to do in this masterclass? Well, the first thing we're going to do is we're going to help you learn to buy your first dividend stock. Simple enough. The second thing we're going to do is we're going to talk about how to put together a portfolio. Now, it's not as simple as just buy stock. And I can tell you that the people who go to the website and they get the Dividend Kings, because we've had this, a couple of people say this in class, well, this Dividend King, this is no good. Because a Dividend King is a stock that has paid dividends and raised dividends for 50 years. That doesn't make it good for our purposes. That just makes it consistent. And consistency is one of the things we look for, but just one. The other thing we're going to do is besides that, we're going to talk about managing a portfolio, doing the whole thing. because people think, oh, that's terrible. That's difficult. I can't do that. Well, with the tools they give you, with the tools we give you in class, it's easy. The problems stick out like a sore thumb. The things that are good stick out, and you can say, wow, this is great. You'll also learn what happens when the market goes down with our kind of portfolio. We don't go down much. What happens when the market goes up in our portfolio? We don't go up much. We're kind of like the tortoise and Aesop's tortoise and the hare. We just keep on going and we just keep on winning. So we're going to talk about managing a portfolio, and then we're going to do something else. We're going to show you the returns of one of my first class members. He sent me an email, but at this point, it's about a month ago. And he said, these are the professional returns that I got because I'm having Fidelity manage some of my money. These are the returns that I got by using your method. I want you to look at this. Then we're going to talk about another class member and what her returns are and how she has done. And then we're going to take a look at my portfolio and how I've done versus the S&P 500. And we're going to show you results. So what are we going to do? We're going to talk about buying your first stock. We're going to talk about how to manage a portfolio of stocks. And we're going to show you the results that we've gotten from class members. Now, click below. Join us, won't you? March 24th at 11 a.m. Eastern Daylight Time. And we're going to talk for about an hour, and then we're going to answer your questions. We're here to help. Thank you. I'm Chip Stites, and this is The Laughing Retirement.